Okay, thank you for joining today's webinar. My name is Jess Wright. I'm Head of Partners and Clients at ShareSite. And today's webinar is all about tax as we approach the end of financial year on the 30th of June in Australia. Today I'm joined by Glenn Frost, a partner at PwC, where he has helped individuals and their families for over 30 years as an integral part of PwC's private clients team. Glenn leads PwC's National Family Office and provides specialist tax advice to a varied of private-owned businesses, family offices, family groups, enterprises, and high net worth individuals. He advises both residents and non-residents and has a diverse range of clients from active to passive investors, retailers, medical professionals, property developers, those involved in startup business operations, and small accounting firms via PwC's Advisor Connections program. He is joined by his colleague Tristan Whitefield, a director at PwC. He has over 14 years experience in advising families and private businesses owners in relation to their income tax affairs, assisting them with structuring to protect and maximize their after-tax wealth and to understand their structure in a simple and practical way. Tristan has a focus on Australian income tax matters, including in relation to family trust, Division 7A, and cross-border tax issues that affect individuals living in multiple jurisdictions. Tristan has expertise supporting families in the transition of wealth to the next generation, preparing and equipping adult children to manage the ownership structure they will one day inherit, as well as their family tax affairs. Glenn and Tristan are on hand to answer your tax questions as our tax experts from PwC. Also joining us today is ShareSite CEO Doug Morris. Doug joined ShareSite back in 2013. Prior to that, he was a product manager at Morningstar. He's an avid and knowledgeable investor and ShareSite user, and he's on hand to answer all of your ShareSite questions. Before we get started, we have a little bit of housekeeping. This webinar is being recorded and we will email it out to everyone in a few days. We're also live on YouTube. If you haven't already submitted your question today, at the bottom of your screen, there's a Q&A function from Zoom. Just type in your question there. If you're live on YouTube, add it in the comments and we'll hope to answer as many questions as possible today. A little bit of housekeeping on the disclaimer. Today's information is informational purposes only and does not constitute a product recommendation or taxation or financial advice. We recommend that you talk to your advisor or accountant to obtain the correct financial advice for your own situation. And with that, I'll hand it over to Glenn and Tristan from PwC to tell us a bit more about PwC and tax implications for Australian investors.
Thanks, Jess. Hi, my name is Glenn Frost and very happy to be here. As Jess mentioned, my role here involves working with a diverse range of high net worth individuals, family groups, family offices, and a large number of smaller accounting firms who use us for advice on a range of matters to help them help their clients through our Advisor Connection program. Just like to reiterate Jess's opening comments around the importance of acknowledging that all our discussion will be general advice, and strongly recommend that you seek your own personal advice for any of your specific circumstances. As most of you will appreciate, tax is a complex area and your specific circumstances will affect the outcome and could change the outcome of anything that we discuss today. Very happy to be here, and I'll hand over to Tristan in a few minutes. When we think about investors and their tax situations, we generally look at it in two segments. So we look at, well, what's happened with the investor and what do we need to do in terms of helping them comply with the tax obligations and implications of what's happened. And so I'll spend a few minutes just talking about that period, coming up to 30 June. And then I'll hand over to Tristan and he'll just share some of the things that we work with clients, which is, post that period in terms of planning and what should people be thinking about in terms of their structure and so on and so forth. So in terms of what's happened, and the obvious place to start is in terms of record keeping. If you don't have good records, you're not going to be able to comply with your obligations and take advantage of any concessions or rebates that are available. The ATO now has a pretty good pre-fill program, but that's not 100% accurate. And generally when it's not accurate is because, companies you invest in, you've given the wrong tax file number or you haven't given the right tax file number. That could mean that you're not getting all the imputation credits you're entitled to, or you're inadvertently under declaring income. So important to keep those records up to date. Notwithstanding, the ATO pre-fill is getting pretty good. The other area where investors sometimes struggle, and I think ShareSight is actually a good way of managing this problem. Trust distributions, there can be a lot of information coming through from managed funds around portions that are tax-free, tax-deferred. They might have foreign income tax offsets. Some of your gains will be discount capital gains that you only pay half tax on. Other of the gains will be non-discount, where you have to include the full amount in your tax return. And of course, the managed funds also distribute the imputation credits. So if you don't have good record keeping, you won't keep proper records or take advantage of all the concessions that are out there. The other thing worth noting from an investment perspective and record keeping perspective is the importance of capital gains and having good records there so that you can maximise your cost base and put the correct information in the returns when you're completing it. Increasingly, people are investing more globally, and that expands their investable universe, but it does actually increase the complexity of what they're investing in. So, for example, when you're investing overseas, you have to keep a record of your cost base, not only in US dollars, for example, if you're investing into a US company, but you have to keep a record of, well, what was the Australian dollar cost of that at the time you went in? And likewise, when you sell, what was the US dollar proceeds that you received, but converted to Australian dollars? And there's a couple of different methods of converting that, but the important point is keeping accurate records so that you know in Australian dollars what have you bought and what have you sold. And any adjustments that happen, in the intervening period. The other things that can complicate and what we often see people miss out on cost base on is dividend reinvestment programs. That if you don't have good records, you'll pay tax on the dividend when it comes in, but if you're reinvesting in the shares, that will add to your cost base. And if you don't have the good records, you may miss that dividend reinvestment, which means you'll pay more tax when you eventually sell than you otherwise should. Conversely, some of the income that you received particularly from the managed funds or property trusts, will be what's called deferred income. Often the reason it's called deferred income is that you don't pay tax on it when you receive it, but what it's doing in the background is reducing your cost base. And again, if you don't keep good records, you'll inadvertently overstate your cost base, which could get you into strife with the ATO. And then there's just normal, what we call capital reorganisations. So occasionally, companies will return capital to shareholders. Not happening much in the current environment. But when they do that return, it generally won't be taxable, but it will reduce your cost base. They may also do share splits where you hold one share and for every one share you get two additional, or vice versa. That means you'll have to split your cost base across those shares. Again, good record keeping is essential to make sure that's being handled properly. And takeovers. They'll often result in a CGT rollover, so you might get shares in a particular company, but the cost base will be tied back to the original company that you may have bought many, many years ago. So it's important you transfer those records. And of course, essential to keep records as to whether a share is pre or post CGT. Particularly important for your beneficiaries of your estate, because when they inherit your shares, they're going to need to know, were they pre, in which case their cost base becomes market value at the date of your death, or did you buy them post, in which case they inherit your cost base, and they'll need to know what that is. So that's some opening comments just around some record keeping, and particularly on income and capital gains. In terms of expenses and investors, what we generally see is occasionally there'll be home office expenses. The government's very generously announced that you can claim 80 cents an hour for your use of your home office since COVID-19. But you can also claim other expenses associated with your investment activity. So common examples could be depreciation of a laptop, monitors, furniture in your home office, on the basis that you're using that for your income producing activities. Likewise, a proportion of your internet usage. It's very unusual. Someone wouldn't use their internet partly for private usage, so make a reasonable estimate. I have a number of clients who are actively involved in corporate, in staying engaged with the companies they invest in, so they will often travel to annual general meetings. So those expenses generally deductible, subject to your specific purposes. And probably a big one for investors is interest. So I would just particularly watch the purpose that you're using any loans for. If you're borrowing to buy income producing assets, generally deductible. Where we see some clients get into confused areas is when they use a redraw facility rather than an offset. And if they borrow and it's got a redraw facility, they'll make repayments. They borrowed to buy shares. When they redraw, they may not always be using that redraw for income producing purposes, and that will taint the deductibility of that portion of the loan. So generally it's easier to use an offset account. The loan remains intact. If you borrow $100 and you offset $80 against that, if you take money out of the offset, you start getting charged on the original loan, which was still for a deductible purpose. So just be careful how you're treating that. And then the final comment is around just interest and prepaying, which many people turn their mind to this time of year. Individuals can get a deduction for prepaying interest. Entities generally can't. Why would you repay? Why would you prepay interest? It's not just tax driven. It's not just to get a tax deduction this year. Some people like the certainty of knowing what their interest rate is, and generally when you prepay your interest, you get a fixed rate, so you know what your interest is going to be for the next 12 months. So factor that into your planning. On that note, I'll hand over to Tristan, who will make a few comments just around what's happening going forward.
Thanks, Glenn. And another point as well, that going back to that dividend reinvestment, and my grandfather had a share portfolio, and when he passed away, I inherited not the shares, I inherited 25 years worth of records to help fix up my father. And everything had been reinvested. There'd been share splits, and he had done nothing in terms of record keeping. And I thought, this is going to take me months. And thankfully at the time, ShareSite had just started up, and I used it with the dividend reinvestment function. It was fantastic. Saved lots and lots of hours. So I'm a big fan. One of the other questions that we get asked a lot about around this time of year is, all very interesting, 2020 is almost over, what am I doing for next year? And part of it could be around, well, what is the right structure to hold my investments? And a couple of common entities that people use might be a family trust or a private company. And there's a whole lot of reasons why you might do that, usually around things like asset protection. If I own something and I get sued, it's at risk. Typically, if a trust or another entity owns it, the rules are different. And so from a tax point of view, you might go, well, what should I use? Do I use a company? Do I use a trust? And part of that decision will come down to, well, what tax rate do I pay on capital gains or on income? And so in a family trust, typically, if the asset's been held, let's say it's shares in a listed company, if those shares have been held for more than 12 months, the capital gains tax discount applies when I sell. So I make a $100 capital gain, discounts down to $50. If I'm paying 47% being the top marginal rate of tax, my effective rate of tax is 23.5%. Whereas in a private company, the tax rate's 30% straight off the bat with no capital gains tax discount. So there's a whole lot of different factors without going into too much detail, but that's one of the considerations there. And then some clients go, well, look, I want a family trust for a whole lot of reasons around estate planning and asset protection and the ability to share income amongst different family members. But I've got a whole lot of cash locked up in a private company. And if I take that cash out, there might be a tax bill in doing that. And so what some people look to do is their family trust will borrow money from the private company. That then goes into a whole lot of other shareholder loan provisions called Division 7A, one of my favourite areas to talk about. Unfortunately, I've only got about 3 minutes left, so I'm not going to talk about that in too much detail, other than to say it's complex, and then you've got to think about, well, do I get a deduction for that interest that's being charged? So once you start including structures, there can certainly be some benefits. There can be a bit of complexity as well. Just picking back up on that point around capital gains as well, in terms of the timing, people might have made massive capital gains, hopefully this financial year up until COVID, and then they go, great, I've made a lot of money. I'm now sitting on unrealised capital losses. And so what's the right timing to in terms of realising losses? I'm just swapping over computers. Right, so in terms of timing, what you don't want to have from a tax point of view is a capital gain up until, say, today, and then I make a capital loss after year end, because then I've had a capital gain in the current year and I've got a loss carried forward next year. So to the extent that I can make a capital loss this year to offset gains, that's helpful, with the big asterisk, read fine print here. One, did I do it just to get a tax benefit? But two, what if the market moves significantly? I pick up a loss today, and if I'd waited 3 weeks, I might have made a big gain. And so it's always got to be an investment decision first and foremost. But if there's things you're thinking of selling anyway, why not do it before 30 June rather than waiting till after 1 July? I'll just hand back over to Glenn to add a couple of comments to that, to that point.
Sorry about the technology battle there. Tristan and I are in the same room and trying to use different laptops. We're getting a bit of feedback.
And we're sort of social distance, yes.
Yeah, yes. And sorry, Tristan, the comment there around revenue losses, what was the point there?
Yes, so then I suppose the other thing to think about is there are a couple of different ways that you can trade. So most investors will be on what we call capital account, and that means that you get the CGT discount. So effectively half the capital gain is taxed. If you've got capital losses, those just carry forward if you don't have gains. And so you can't use those capital losses to offset against your employment income, for example. Contrast that to what we call revenue account, which is when you go, well, if I'm a share trader, I'm actually in the business of trading, and so my losses are therefore potentially deductible against other income. And so there's a whole lot of case law around that that's come out recently. And some people might remember at the time of the GFC, just after that, there were a whole lot of people going, oh, I'm a share trader now, I'm on revenue account, I'm going to use my massive losses to offset my employment income and get some tax benefits. The ATO then cracked down on that over the following 12 months and scrutinised it. And really it comes down to, the bottom line is, am I carrying on a business or not? And there's a whole lot of factors you've got to go into around repetition and regularity and record keeping, importantly. And so it's not straightforward, but it is something that is possible depending on how you've structured your affairs and what your intention was at the time you bought those shares. So those are some of the key things we see. Jess, just conscious of the time, and I'll hand back over to you.
Perfect. Thank you very much. That was a great kind of intro to tax obligations. I'm going to pass it over to Doug to give us a little bit more information on ShareSite.
Sure. Thank you, Jess, and thank you both Glenn and Tristan, and hello, everybody. Thank you for joining us. I'm just going to share my screen, and what I thought I would do, I won't take up too much time because I realize that most of us are here to learn from the tax experts. And again, big disclaimer, I'm just the software guy. So ShareSite is here to help you, especially in the record keeping side, obviously for performance reasons, but also for tax preparation as well. But please do check with your accountants before acting on anything that I say or demonstrate here. I guess just to kind of pick up on a couple of points that I heard Tristan and Glenn mention, the first one is around structuring portfolios. So when you create a ShareSite portfolio, we ask you which entity you'd like to set up. And you can change this at any time, by the way. So if you're looking at my sample blue chip portfolio here, I've gone into settings and tax settings. And for this example today, I've just got a portfolio set up with as an individual discretionary trust with a CGT discount of 50%. But you can toggle that if you've done it in error and you want to change it later on, or you shift your affairs to an SMSF, for example. And this rule will be applied throughout the reports as well. Also, just picking up on a comment that Glenn made around the increasing popularity of international investing. So as you can hear from my accent, I'm from the States originally, though I've been living in Australia for 10 plus years, which means that I've got a very nasty tax reporting situation on my hands every year. And it's a real pain. And I suspect, based on the feedback we get from our customers, is that many of you do as well, especially with the proliferation of ETFs and low-cost brokerages that make it easy to trade in overseas markets. So what we do at ShareSite is, depending on the plan type that you're on, when you create a portfolio, you'll be asked to denominate the portfolio in a specific country. That not only dictates the currency, the base currency of that portfolio, but it also dictates the tax features that are available in that country as well. And so, if you set it to Australia or New Zealand, for example, each portfolio will be run respective to the tax rules and give you the features necessary for their reporting regimes and their tax offices. And also, as Glenn said, we like to keep those portfolios sort of based in their home currency for those tax reasons, because you'll need to track the cost base in both currencies in most cases. You can always do a consolidated view down here at the bottom of the portfolio drop down to look at performance across all of your entities, but we do keep tax distinct for obvious reasons. So we think that's a real important feature of ShareSite, just around helping you manage different assets across different countries, and also running tax reports and date ranges respective to your tax entities as well. Just a quick note on the record keeping features of ShareSite. Many of you would have already set up your portfolios already. Just nothing is set in stone at ShareSite. You can always go back and add historical data to a portfolio at any time. You can do so in various ways. You can import from a broker through one of our sort of 15 or so local broker connections. You can import from a CSV, a spreadsheet file, or you can manually add trades as well. So if you've set up your portfolio now and you're not quite done, you can always go back in time and add history to the portfolio, and it'll catch up automatically. There's another option available to you when you're adding holdings to ShareSite via any of those mechanisms, and that is to not only start with a buy trade. So if you have access to your transactional histories, you can also start with an opening balance as well. And so Tristan mentioned the 25 years of history that he had to deal with, and being a tax professional, I'm sure he secretly maybe liked doing some of that stuff. But if you're like me and you want to just kind of have a clean cut and start from 1 July, you may want to look at using our opening balance feature as well, which will sort of put a stake in the ground, and then ShareSite will kind of do all of its auto magic stuff going forward from there. Quickly moving to another topic that I picked up on, which was DRPs. So if you have a DRP, let me just find a good company here to show you a DRP example. I'll find a local Aussie company. Oh, just bear with me 1 second. I'll add a new one. Oh, here's CBA right here. That'll work for us. If I click on my position in CBA, you then come into the CBA holding specifically. Way down here in the bottom right corner is a very important box called holding settings. This allows you to delete the holding altogether, FYI. It allows you to do a merge transaction. So if there's a corporate action like a takeover, which was mentioned previously by our mates at PwC as well, you can enact a merge feature, which kind of brings up a wizard and will allow you to put in the parameters of the merge. And you can also flick on the DRP. This will give you a warning, because in this case, it's about to reinvest my entire history of dividends paid out to me by CBA. But this basically executes a small buy transaction at the appropriate DRP price automatically for you, going back to the inception of your holding in this particular investment. So it's a great feature, but it's a powerful feature that flows through to your tax obligations as well. And then finally, I'll just jump into our reports here, specifically through the lens of tax preparation at ShareSite. I suppose the volatility we've been seeing means that a lot of us are sitting on losses. And when I think of tax losses, I think of using them to my advantage. I like to think of 30 June as a sort of almost a stake in the ground, a disciplined way to cut bait on some of these investments that I've been holding on to for too long, and to use that credit towards something else. So if you run the unrealized CGT report, You can set the as at date to be any date between today going back, and it'll show you the short-term capital gains, the long-term capital gains, and importantly, the capital losses that you're sitting on. So ShareSite knows all this information in real time, and it will apply the tax loss credit down here in our summary calculation to show you what credit you might have to take advantage of at the end of the tax year. Moving to the capital gains tax report. So these are the gains we've realized throughout the course of the date range that we set here. Just a pro tip as well, always make sure you're looking at the appropriate date range on all ShareSite reports. It dictates all of the information and the calculations below the fold, so to speak. In this case, I'm just going to do since inception because this portfolio has a lot of history, and I'll just to show you as a nice juicy example. Much like the unrealized report, this is structured as long-term capital gains, discounted capital gains distributions from my ETF positions, capital losses as well. Very powerfully on this report too, you can actually modify the sale allocation method. And I know we've got a question about this, which I'll defer to our tax professionals on the webinar. But you can select to set the allocation method either at the holding or the overall portfolio level. And you can choose between 5 different options. So FIFO, LIFO, maximize gain, minimize CGT, right? So this is basically our attempt to automate and make easy for you parcel selection and do it across a potentially large portfolio with lots of holdings and trades. And just to show you a quick example here, you'll see that I'm sitting on a long-term capital gain for a position that I sold out of in Xero on the 19th of March, 2020. If I change this, and I'll just do Xero, from first in, first out to last in, first out, and I update, it's going to warn me because this may change my tax obligations. It will then recut the report, and Xero has now dropped out of the long-term capital gain category and moved to a capital loss. And that's because I recently bought shares in Xero and I've disposed of them recently as well, turning a long-term gain into a capital loss. That's not a very practical example. Why would you want to do that? But just to show you how you can play with the reports, and it can chop and change the way your records are kept, and again, your tax obligations. Once you're happy with that, you can also apply a lock date as well, which is very important to keep those previous years locked away in the format that you used in ShareSite, and therefore the format that you reported to the ATO. And then finally, on the topic specifically of dividends and distributions, dividends are fairly straightforward. Dividends are paid by companies. That information is collected by ShareSite and reported against your taxable income position and your performance. We've talked about DRPs. But as ETFs become more and more popular, ETFs being trust instruments, I think our stats show that ETFs now make up about 20% of the current positions in customer portfolios across Australia. So that's gone from real low single digits 5 years ago all the way up to 20%. Which is a trend we've seen happen in North America and Europe as well. ShareSite in our taxable income report will isolate these for you. So this is trust income here. You can see in this example, I've got a lot of trust income because normally these ETFs are paying quarterly distributions, and they tend to be very complex. The AMIT regime has come out over the last couple of years, adding quite a bit of complexity to these distributions, and those come in the form of the subcomponents that roll up to make the overall distribution of these ETFs. And so if you think about what an ETF is, it's a portfolio of hundreds, if not thousands of stocks. And those individual positions are all getting, interest income or dividend income themselves. And that all rolls up to you as the unit holder. And they can make things quite complex for self-directed investors come tax time, even though ETFs are often sold as a simple solution to investors. And indeed they are, but they do come with complexity. And you might recall any of those computer share statements you've received in the post that show a real long, nasty list of those AMIT components, AMIT, for your distributions. Now, what we do to make this easier for investors is we will show the gross amounts of those distributions as they come in from our data providers throughout the course of the financial year. And then we're working directly with registries and certain ETF providers themselves to get the actual breakdown. And what we do after 30 June, so this tends to happen in sort of July to September, we get that data and we then repopulate those distributions inside of your portfolios as well. And so you'll see those kind of change inside of your portfolio. Where we do not receive those distributions, and some registries and some ETF providers, quite frankly, just don't want to play ball, we've built a wizard which will allow you, and I'll show you this here, advanced options, show holding totals, and then I'll change this to current or last financial year. We've built a little wizard to allow you to actually enter the distribution components yourselves based on the information sent to you from the registry. And the feedback we've received from our customers, being self-directed investors, and our accounting customers and partners as well, is that this is an acceptable form for the ATO. And what you basically do is you enter an amount here. So let's just say for franked amount, it's 100. That is then prorated back across when those distributions were paid, based on your unit balance in the holding in the tax year. So it's quite a powerful feature that's embedded within our taxable income report as well. And again, if it seems complex, ETF distributions are complex, and we've tried to build quite a lot of rich functionality inside of ShareSite to help investors with those ETFs. And the final thing that I'll say before handing back to my colleague Jess is that, I'm an investor, I'm not a tax professional, and I think a lot of us are better off spending our time making investment decisions and running our own portfolios, as our own sort of family fund managers. We always encourage people to share access with their portfolio with their accountant as well. So, if you use somebody of the caliber of PwC, if you use, your trusted suburban accounting firm, you can share access to the portfolio here, and you can give the accountant even read and write access so they can actually make adjustments and changes inside of the portfolio as well. And we do think that this will allow them to have insight into, obviously, your records. It should also reduce perhaps the amount of sort of outlay in terms of cost that you need to provide to your accountants in terms of data gathering and getting everything set up just to then do the tax work. So in closing, ShareSite's obviously designed for performance tracking, but it's also designed for tax prep. And we think that this kind of ongoing real-time process of record keeping will allow you to make investment decisions and tax decisions, before, say, the 29th of June. So we do hope it's quite beneficial for everybody on the call in the lead up to 30 June. And with that, I will turn it back over to Jess so we can bring back in our experts.
Perfect. Thank you very much, Doug. So let's start with your questions. So we've actually had a lot of the questions already answered with everyone just kind of doing their first little talking points, but let's start with some of the questions. So first question for Glenn and Tristan. How soon can you repurchase shares after a sale for it not to be considered by the ATO as a washing? And for the audience, for some of the audience, can you please explain what washing is?
Yes, thanks, Jess. A wash sale is where you're buying and selling a share, but you're not really changing your economic outcome. And so the example I was giving was, if you own BHP shares, you've got an unrealised loss on them, and you decide on the Friday that you want to sell those, and then on the Monday you decide to buy them back again. And what the ATO has come out and said is, well, if the only thing driving that decision is a tax decision, then they will look to deny that loss because your economic interest hasn't actually changed. And so the question is, well, how long should you leave? That, unfortunately, like most tax questions, there's no answer. It will depend on your circumstances. And if you were to reacquire, first of all, the sooner you reacquire, the more it looks like you're doing it to just have crystallised the loss. Secondly, you would want to have a change in circumstances. So you'd want to be able to point to something that has changed or influenced your decision so that you can determine that it wasn't just trying to crystallise a loss, something had changed and therefore you had decided to go back into that. And that could be an announcement the company has made, but the longer the time, the better. The other thing to think about is, well, maybe the better choice, and again, you don't want tax to drive your investment decision, but if you were to sell out of Westpac and buy into CBA, that could be because you're making an investment decision that you think CBA is better, and then you're in the same industry, but you're taking a different position in a company. that is not a wash sale because you've changed your underlying economic interest. Hopefully that helps.
Perfect. Thank you very much. And we got there on the sound. That's always good.
Yes, eventually.
Not to worry. It's the joy of live. So another question for you guys. Well, the kind of sound's working. What is the tax treaty for stock that are gifted by the broker? So, for example, Robinhood and Stake and other brokers sometimes gift stocks when you receive them, as well as when you're selling them. So, do you have to put the cost base as 0, or is the cost base at the date of receiving the stock?
Yeah. So I haven't actually looked at that at all. I know that there are rules that if you have a transaction where there's no consideration, then it's deemed to be market value. So those rules could apply, but I haven't looked at it specifically for how Robinhood structure that. The general principle would be if you pay nothing, your cost base is probably nothing. However, you'd need to look at those other rules that say, well, where there's a transaction and there's no market value, you can be deemed to have paid market value for it. So that's sort of a non-answer, but that would need some specific investigation of, well, how are Robinhood structuring that?
Okay, not sorry. Thank you very much. Can you chop and change the sale allocation method on shares in the same portfolio entity? So, could you do LIFO for one and FIFO for another?
Yeah, I think you can choose a reasonable method. And like at the end of the day, if you think about, well, what are you actually achieving? Like it's a timing difference. And so you might go, I'm going to do first in, first out now, or I might choose all my high cost base shares first and then the low cost base ones later. It's effectively timing. But there is flexibility there to do that.
Perfect. Thank you very much. Okay, at what point can an investor be classified as a trader by the intervention of ATO, not by the investor's choice?
That's an interesting question because it really comes down to a matter of fact. Like, are you trading on revenue account? Are you in the business of trading, or are you investing? And so it's not so much that the ATO will say you are a trader. It's more that they might say, well, we think the appropriate categorization of you is a trader. In a period when there's a lot of losses going on, they're less likely to make that assumption. But if that's appropriate, given the circumstances, then sure. Usually you've got to have, as I hinted at before, there's ATO, there's guidance on this in case law, but you've got to have, firstly, what's your intention at the time that you bought those shares? Was it for long term, was it for profit, or was it just to get dividend flow and maybe some capital appreciation? And you need a high volume of trading. So there's some recent case law out there where someone had bought 64 trades or something in a number of days on a particular stock. There was things done in a business-like manner. They had a certain skill set in the financial industry that gave them the qualifications to run a business in that industry. And so they were classified as a share trader. So again, it comes down to a question of fact.
Okay.
And the comment I would make is Tristan highlighted before that post GFC, there were a lot of people who tried to argue they were share traders. And so if you have any concern or confusion, absolutely seek advice. You can also apply to the ATO and get a ruling from them, just asking them, saying, look, based on my fact pattern, I think I'm a trader, and I think I'm a trader for these reasons: the volume, the regularity, my intention, and set out your fact pattern. They will actually give you their view, and that will give you some certainty. If they agree with you, great, and you claim the losses on revenue account. If they disagree, or they were going to disagree with you when they reviewed your file in a year or 3 years' time, so better that you know now and you make the right choice before you lodge the return, rather than have a battle after the event. And obviously, the more material that is, the more involved advice you should get, and the more you should consider engaging with the ATO.
Perfect. Thank you very much. And we've had a lot of questions about US trading, like in trading in US stocks. So how do we account for the capital gains on losses on US stocks? And how does that work with gains and losses on those?
Yeah, so the same rules apply in terms of, gains on foreign assets are still taxable, still discountable. The complication comes with the Forex that you have to convert what you paid originally in US dollars back to Australian dollars when you bought it, and then you have to convert on sale back to Australian dollars the US dollars you get.
And then the added complication comes, well, what do you do with the proceeds? So I think the actual calculation of the gain is relatively straightforward because you are just converting foreign currency, and it's a statement of fact. What was the exchange rate on that day? The ATO publishes daily and monthly exchange rates. The complication can come, well, what if you leave it in cash? And if you leave it in US dollars, then you're going to have to make some decisions around how you're going to treat that, because you might make a gain or loss when you bring that currency back, and you might make a gain or loss each year if you have more than $250,000 in foreign currency. Then there are certain elections you can't make, and that might mean that you're taxable on movements in the exchange rate, even though you haven't brought it back. So storing cash overseas can bring added complexity. A straight purchase and sale of US stocks adds some complexity, but generally not a great deal.
Fantastic. Thank you very much. We had a question come through the ShareSite forum. If someone earns under 5,000 per year for the capital gain, is that classed as a hobby? And if they earn over that, is it classed as a business, and can they claim losses and subscriptions and etc.?
Yeah, and as Tristan hinted at before, under 5,000 is not a hobby as such. So if you buy BHP shares and you make $100, that's still a capital gain. So there's no threshold. If that was the only thing you had in the year, you'd be under the level at which you pay tax anyway, so that wouldn't matter. But whether you make 5,000, 5 million, or $5, a capital gain is a capital gain on shares. The second part of the question around, sorry, what was that second part? Then the business element. It comes down to, do you have a high volume? $5,000 is not a high volume. So do you have a high volume, both in dollar value and frequency of trading? One trade is almost inevitably not going to make you a share trader. You need that high volume, high value business-like methodology and structure to become a trader, to then open up the treatment of that on revenue account, which is a good thing if it's losses and a bad thing if it's gains, because you'd lose the CGT discount.
Brilliant, thank you very much. What's the tax implications for being involved in a buyback scheme? So if one company buys another company, what are the tax obligations, particularly currently if it was a loss?
So maybe you should answer that one. Okay, sorry.
Okay.
I'm loving the wheeling.
Yeah. So if it's a buyback, it will generally give rise to a taxing point, and how the company funds that buyback will dictate the tax outcome. And generally, the company will tell you that if they're giving you $100, they will tell you how much of this is a return of capital and how much of it is a dividend, and whether that dividend is franked. And so every buyback is different because it depends on the balance sheet of the company doing the buyback and what proportion is being funded out of retained earnings. Generally, all buybacks will have a taxing point. Part of it will be capital, part of it will be dividend. You can get the situation where you get a taxable dividend and realise a capital loss because only a portion of it is a capital return. So each buyback is going to differ, but when they announce it, they do give you quite a bit of information around how you need to treat that.
And Jess, maybe I'll just interject there around ShareSite functionality on corporate actions, which is it's a big topic for investors, obviously. ShareSite will automate the corporate actions that it can. So things like splits and certain other corporate actions, if there's not an investor election involved, we'll automate those for you. We'll always tell you what we're doing, but we do make available to you all the transaction types. So buybacks, cost-based adjustments. There's a whole long list of corporate action adjustments that we allow for as transactions inside of a holding in your portfolio. But look, in my case, just to add a bit of sort of practicality, I don't tend to handle those complicated ones myself because I'm sharing access with the accountant and I let them do it at the end of the year so I don't make any grave mistakes. But we do make that functionality available just so people are aware.
Perfect. Thank you very much. We've got a question about employee share schemes. So if you sell shares that you've received from an employee share scheme, what happens at tax time for those?
Yeah. Part of the answer is it depends, which is not really an answer, but depending on how the scheme is structured and the particular elections that the taxpayers made, there's different ways that share schemes can be taxed. And so one is that when I get the shares up front, I pay tax when I get them. So I get $2,000 worth of shares, I pay tax up front. That's my cost base going forward. If the share scheme dictates that tax is actually paid on what we call vesting date, or when certain restrictions lift, you pay tax at that point in time. And so maybe when I got the shares, they were worth $2,000, now they're worth $10,000. I pay tax now at $10,000 when I get those shares. And so in terms of the cost base, it really depends firstly on, well, when did you pay shares at grant or the deferred taxing point? And then when you sell them, you look back to, well, how long have I owned the shares now as well to work out discount. So that's what I mean by it depends. And there's also some exemptions as well. There's some thresholds around less than $1,000 depending on the way the scheme is structured. There's different rules that apply there again. So that's what I mean by it depends.
Thanks very much. We've had a question kind of about SMSFs. So is there kind of things that people need to be considering as a trustee of an SMSF?
Very broad question, and the answer is yes, there are things. And
On the high level.
There's a whole raft of concessions that come with running a self-managed super fund and obligations. And so trustees are responsible for having an investment strategy, for example. And so they need to document how they're going to invest the fund's assets, with an eye that the primary objective of an SMSF is to provide for retirement of the members. So they have to take into account the members' circumstances and document how they're going to meet the objectives of providing for the retirement of the members. A quick example of where I've seen the ATO raise eyebrows in the past is where an SMSF has quite old members who are very close to needing to draw down a pension, and yet all the SMSF's assets are in direct property, which they can't sell a small portion of to fund the pension. And so the ATO has sort of questioned that and said, well, how's that investment strategy going to help you support a pension for the members? And in that case, it was very, very low yielding property because of the nature of it. So that's sort of a broad comment. They have to worry about the investment strategy. They obviously have to worry about complying with all the rules and obligations. You know, you can't be using the fund as a personal bank account. You know, you've got to be using it for the retirement of the members. And you have to be across, well, what are the obligations of being a trustee? You know, you have to make sure you're getting the accounts audited, tax returns prepared, the fund's not borrowing unless in very specific circumstances that are highly structured, the fund's not lending to related parties. I think that my advice would be to make sure that trustees are across the rules, and the ATO publishes a lot of documentation on what trustees should do, and basically have first and foremost in their mind that the SMSF is for the benefit of the members' long-term retirement. And if anything you're doing doesn't gel with that, you probably shouldn't be doing it.
Thank you very much, Glenn. A question for you, Doug. Sean's come back and asked, how do you handle employee share schemes inside of ShareSite?
Yeah, that's a good question. First thing I'll say is we've done some blogging on this topic because it is a common way that younger people are incentivized, especially if they're in middle to senior level roles at companies. So Google ShareSite and some related terms that'll provide you a good answer with some workable examples. I think I wrote those a couple of years ago myself, actually. But essentially, the way that I explain the share schemes to, say, my partner or friends who kind of think of them one way, but ultimately you're being forced to, it's like a company is handing you a bonus that then they're forcing you to invest in their shares. And if you think about it that way, it'll make more sense from the performance and tax tracking implications, because ultimately you're getting those shares and they have a cost base attached to them, which then kind of puts an anchor in the ground for tax. And so what I've done personally for my own investments, a previous employer, a US listed company, I actually used opening balance, which would be the grant price, and I would track those from there. It gets a little bit different if if there's vesting schedules, or if there's like an option you need to exercise to then own the shares. But a popular scheme now is RSUs, or RS, whatever the acronym is, restricted stock units, typically, where you're kind of granted shares straight away. But again, they come with a cost base, and you need to work out what that cost base is. It'll be in the literature of the bonus. You can stake that as an opening balance. And then really what you want to do is track the performance from there, to think in terms of an investor, think about, hey, I've been given these shares as a bonus. I need to make sure that they're working for me, basically. So again, go back and try to find that. Just Google ShareSite and employee share scheme or something like that. And we've got some good content on that topic.
Thanks very much, Doug. I've actually linked it in the questions, the blog. So Sean, you can access it there. So now a question about pensions. So this is to Tristan or Glenn, whoever would like to wheel in and answer the question. So a pensioner requests their super fund withdrawal to withdraw their super and pay it into their bank account as a lump sum. The fund processes the withdrawal. However, not all of the funds are paid prior to the person's death. The final amount is paid to the person's bank account a few days after their death. This amount is then forwarded on to a non-benefactor beneficiary. Does this fund, do the funds that are paid after the death have any tax obligations, even though they were requested before the death of the individual?
Probably is the answer. It sounds like a very, very specific fact pattern, and I think that you should probably get some specific advice on that, because at the danger of a little bit of information is dangerous. So I think that if typically what happens on death is all of the assets that you own and things you're entitled to transfer to a deceased estate, and then are dealt with there. So I think what part of the answer will be, well, what was the timing? Did they actually, they've made the withdrawal, they've made the request, everything's been executed? Is it therefore effectively just timing between effectively like a contract date and a settlement date, and it's just timing around when the cash hits the bank account of the deceased person? Whereas if they didn't actually make the withdrawal, they just intended to, then I don't think it would actually be a pension withdrawal.
Yeah, and I think if they've cashed out of the allocated pension, then that's an investment decision that the SMSF has made. It then has to make a separate decision to pay an amount to the beneficiary, and it sounds like, and again, Tristan's right, these are very specific circumstances, so you need to get specific advice, but it sounds like a pension or a payment's been requested, but it may not have been made. And so therefore, I suspect that the answer was probably heavily caveated. It probably forms part of the estate of the individual. I don't think it would be a pension payment on that very limited fact pattern, but the trust deed will determine the specific facts, and you're going to need some specific advice on that issue.
Perfect. Thank you very much, guys. I think that's unfortunately all we have time for. We've kind of run over already. I'd like to say thank you very much for Tristan and Glenn from PwC for joining us, and Doug from ShareSite. It's been very informative. If anyone, we've had a few questions about ShareSite. We have a very extensive help centre that you can find lots of questions. If you have any further questions on ShareSite, not on tax, on ShareSite, please reach out to the support team at support@sharesite.com. We've also running more webinars. Next Thursday, Ben, our product manager, is running a webinar about the CGT and taxable income report. So if you go to sharesite.com/events, you can sign up for all of our webinars there. And we're also running weekly getting started webinars for anyone who's new to ShareSite. Again, thank you very much for all attending. Would anyone else on the panel like to say any words?
I'd just like to thank Glenn and Tristan both very much for their time. I thought that was great. And there's a lot of participants and a lot of questions. So clearly this has been a successful webinar, I think. Thank you, guys.
Yeah, and thank you for hosting us. We will share with Jess our contact details. So if you do have questions, there'll be contact details there. And good luck investing in the current environment.
Thank you very much. Have a lovely rest of your day, everyone. Bye.
Thanks, everyone.